I believe Bitcoin will have more purchasing power in 20 years. That's not year to year, but certainly decade to decade. Like, I get asked all the time, like, what do I think is going to happen with the price of Bitcoin? And I say, I have no idea.
Figuring out where it will be in 10, 20, 30 years is easier than where it will be in 10, 20 days or weeks.
100%.
2013, you're working in New Jersey, and you said it was a big problem. How big of a problem?
I would say it ends up being a tech problem and an operations problem. So I'm just like, hey, Wells Fargo, hey, Bank of America, like, why don't you give bank accounts to people in West Newark? And the answer was...
Zac Townsend is the CEO and co-founder of Meanwhile, the world's first Bitcoin life insurance company. He was California's first chief data officer and the founder of a banking API startup acquired by Silicon Valley Bank. With deep expertise in finance, tech, and policy, he's now reshaping how we think about financial security.
Life insurance in particular can be like needlessly complicated. That complication partially exists because of the way life insurance is sold, right? I'm aligned entirely that like this is like a basic fundamental tool. It's not just that it's boring. It's also that the associations that people have with life insurance is like this thing that's being sold to you,
right?
Not a thing that I choose to buy because it's solving this like fundamental need I have in my family.
Zac, thanks for joining me today.
Glad to be here.
You work in the most boring industry in the world, and I'm sure whenever you mention it, people probably run for the hills.
Yeah.
But it's actually something I'm super interested in.
Cool.
Something I spend a lot of time with, but I think it's because people misunderstand the tool.
Yeah.
So the dirty word we're going to talk about is insurance.
Mm-hmm.
Maybe it's as bad of a conversation starter at a cocktail party as maybe taxes.
Yeah.
Right? But it's a super powerful tool if you know how to use it. Most people just don't.
Yeah.
So I want to get into that. I think there's I talk about it because there's a way to build massive wealth, tax efficiency, legacy planning, and extra capital to even work with in some way if it's done right. But most people just don't understand that, so they think, oh, like insurance, like stop, right? But there's a lot that I want to dig into. So before we get into all that, give me your Bitcoin journey and tech and Bitcoin, and then why the heck insurance? But let's start with like tech, your early life in tech, what you've built, and then how you got into Bitcoin.
Yeah. Actually, to start a little bit before that, I worked for Cory Booker, who's now a senator, but he was the mayor of Newark, New Jersey. And I was like the head of innovation, CTO of Newark. I had grown up in New Jersey, had like studied finance and data science stuff. And I got assigned the financial inclusion portfolio. So I was really asking this question of why do people in West Newark not have bank accounts? And like, why do they do check cashing? And that's sort of what launched me on this whole journey. So Cory decides to run for Senate.
Yeah.
And I was like, I don't care about the Senate. Like, you can't do anything in the Senate.
Yeah.
I want to build stuff. And I had this background in data science and fintech and getting stuff done, like interacting with this financial inclusion. And I really just went on Hacker News, which is like Y Combinator's forum. I was like, what's the most innovative fintech company that keeps coming up? And that's how I ended up moving to San Francisco, is I got a job at Stripe. And I didn't really know much about credit card processing or much about them, other than they were doing a cool thing using tech and finance.
Yeah. What year was that?
That's 2013.
Okay, early. Let's stop right there on that part of the story, the financial inclusion piece.
Yeah.
So if you can remember, that was a long time ago, a whole nother world ago for you, right? 2013, you're working in New Jersey, and you said it was a big problem. How big of a problem? Do you have any remembrance of the numbers at that time? And why is that a problem?
It's why it's a problem is like still somewhat mysterious to me. I think that fundamentally, I would say it ends up being a tech problem and an operations problem. So because Cory is Cory, I got to talk to like big banks. I'm just like, hey, Wells Fargo, hey, Bank of America, like, why don't you give bank accounts to people in West Newark? And the answer was, it's actually unprofitable. Like, the accounts are so small, and the operational costs of serving those people and servicing those accounts makes the like unit economics upside down. And my immediate takeaway at the time was that doesn't make any sense, right? Like, the cost of a database entry is free. Like we're all like the transactions in the bank account are not more complicated than the transactions like running through Twitter or Facebook. Like it shouldn't be that expensive. Now I would say I like have a lot more nuance there. Like there's fraud, there's like risk,
KYC,
like how do you manage
and
KYC,
and
like.
compliance.
But at the time I was just like, these are database entries. They should be like almost free. Thus, everyone should have a bank account.
Yeah.
And now I've like been on this whole journey, but this sort of, I skipped over it, but like I grew up relatively poor. I mean, my dad was, or lower class. Like my dad was a postman. My mother was a waitress. Like we like clipped coupons. So I was like very inherently interested in this question of like money. But definitely spending time, I forget the number, but like 25% of the people in Newark at the time were using check cashing.
Okay.
And didn't have a bank account. So I was like, this is just like profoundly broken.
Most people can't even imagine that. They don't live in that part of the world. They don't realize that about 1.5 billion people in the world today have no access to banking. And it's not just the world, it's the U.S.
Yes, that's now. I mean, you got to think 10, 12, this is like before Chime, before Square Cash.
So it's even
like
bigger.
Before Venmo. Like, it was even a bigger problem then.
Okay.
But I am, not to come to the present, but like, that's partially why my co-founder and I are both profoundly interested in this. You mentioned 1 billion people. That's actually what we say. We want to serve 1 billion people, which is like 10 times more than the number of people who have life insurance.
Yeah.
And the point is just that digital money. Well, anyway, I'm skipping way ahead.
Yeah. So let's go back. So then you move to San Francisco. You get a job with Stripe.
Yeah.
And for those that don't know, they're one of maybe, I don't know, the fastest growing, biggest online payment processors. Certainly in the online niche for sure.
Yeah.
I was with them forever. They were great. And then about a year ago, for some reason, they decided to shut my account off.
I haven't been there in 12 years. I'm responsible for that. I wasn't the risk team though, so maybe I made a mistake all those years ago.
Yeah. So you went there. What happened?
Yeah, basically I got to Stripe, and it's sort of a funny story. Simultaneously to applying to Stripe, a good friend and I applied to Y Combinator.
Okay.
So famous startup accelerator. And so I started at Stripe, and then YC offered us an interview. And, it ended up being the best life decision I ever made, like to do Y Combinator and start a company. It was obviously like one of the worst financial decisions I ever made because even the small amount of stock I had would be worth, I try not to like do math, like tens of millions of dollars.
Yeah.
But I think even in the few months I was there, you do get inculcated pretty fast into like, you can just do things and you can just build things. And like, I remember vividly almost every email in the company at the time would be BCC to an email list that you could subscribe to, or you could really see what the company was doing. I remember I woke up, and I had, 300 emails, and it was all Patrick, the CEO of Stripe, emailing our 300 biggest customers, just saying like, hey, how's it going? Like, is there anything we can do to change? So it was a very short but fast education in, I think, the ways of Y Combinator, of startups, of, just being an agent in the world, an entrepreneur. And then, interview at YC, get into YC, and started a company called Standard Treasury. Same thing. Standard Treasury built financial infrastructure. It was relatively another like boring topic. We built like API layers between banks and fintechs. Stripe actually ended up being one of our biggest users with, they had like a company in a box product called Stripe Atlas. And the bank, you get a bank account when they open the account. But it was sort of all of this part that like, how do I use technology to like lower the marginal costs of these like basic building blocks in finance?
Right.
And that company was a little, people won't be aware, but like there are many successor companies. Many people have done this afterwards. Actually, 2 of our engineers went and founded another company that did it. One of our engineers moved to the UK to start a bank. We were just too early. Like we couldn't really get the bank partnerships working. And ultimately sold that business to Silicon Valley Bank, which was a going concern in 2015.
Yeah.
And like a respectable place to sell the company.
Yeah.
And yeah, in that journey, that's when I was first introduced to, actually the very first time I ever heard about Bitcoin, which I sort of regret not like going, is a bunch of the infrastructure engineers at Stripe, like were mining Bitcoin in their MIT dorm rooms.
Yeah.
And it was like a dinner conversation or something. But it seemed quite distant for me. And the first time I really got it was in 2015. I was selling Standard Treasury, and Coinbase was interested in buying the company. Not really because they wanted the financial, like the tech we had built, but because they wanted like payments expertise and KYC and AML expertise, and we sort of had that. We were a small team, but like we really knew that stuff well. And so the first Bitcoin I ever received, I don't remember if it was Brian or Fred, but like literally they like download the Coinbase app and like sent me Bitcoin.
Yeah.
And I understood immediately, even with the little experience I had at Stripe, but then the big experience I had at Standard Treasury, that like this was something categorically different, right? Like it was so fast.
And that's because you had been focused on lowering costs in finance specifically.
Yeah.
And so all of a sudden you saw that and it like clicked for you.
Yeah. But I guess didn't click enough to sell my company to Coinbase.
Yeah.
And then I mean, we can talk about the other parts of my professional life, but I've basically been like dollar cost averaging into Bitcoin since then. Definitely like sort of saw the ICO bubble of like 18, 19 and sort of thought that was ridiculous. And really came back to it like when it was the right like moment in my life to start a company again.
Yeah. Now, I'm curious a couple of things. So one, it kind of shows your focus, right? Lowering costs, more inclusion, things like that. But you said that, going to the Y Combinator and the short stint at Stripe and things like that maybe weren't the best financial decisions, but worked out really well. And you said that you had a short education, but something that was really impactful. I'm curious, as you founded different companies, what are some of the key things that you've learned there that you continue to repeat in the businesses that you run now?
Yeah. I think I alluded to it, but I think that people often like think they need permission from other people to do things. And I think being an entrepreneur is realizing that there's no one else to do the work and that you can just do it. Like, I look back even over the course of this company, we've been running it for about 3 years. I didn't know anything about life insurance when we started. I mean, I knew a little bit about it. I knew enough about it to say, like, I think there should be a Bitcoin life insurance company. But I just had to go and learn it. Like, I had to, like, read legal documents and, write a business plan and recruit people. And I think that you can, and I was on this train too, right? Like, you go to a good high school, you, like, get straight A's, you, like, do well in the SAT, you, like, go to a college. It all seems very laid out for you. And there's just, like, things you can achieve. And entrepreneurship is a lot of ambiguity. And you just have to wake up and, like, decide, what am I going to do today? Just like, and like, how do I push the company forward? And there's no one telling you that.
Yeah.
But you also like come to realize like you can just do things. Like everything, it's actually this amazing like change in perspective. Like everything was made by someone. How this microphone was designed, like someone designed it.
Right.
Someone on your team decided how to set this up. Like every single thing in the world is the result of agency. And most people just don't act that way.
Why?
I don't have a good answer. I've sort of always been this way, maybe. It's something I think a lot about, like on my team and my children. Those are different things. Is like, how do you instill a sense that like the world is a place where you can be an author? It's harder. It's more uncomfortable. Like you fail a lot. And my first company is essentially, I mean, it's looked back on, like I learned a lot, and venture capitalists and other people think we were geniuses. We're just too early.
Yeah.
But at the time, like I put 3 years of my life into a company, and we sort of like failed up into like not an acqui-hire, a little more than acqui-hire with SVB. And that's like, I think it could be crushing.
Yeah. I also think about this question a lot, so I was curious what your thoughts were on that. I think maybe as you become a father, you think about it even more, because I'm trying to think about my kids and like, how could I instill this in my kids, and is it nature versus nurture, things like that. And we were just talking before we started recording last week. I went up to Canada. I took my youngest with me. I like to do individual trips with my kids. Took my youngest up there, and we did some snowboarding and heliboarding and things like that. And I was asking her these types of questions, you know.
How old is she?
She's 15.
Okay.
And so, you know, I asked her, like, well, we were talking about, like, imagine, like, most people, they get, like, 2 weeks of vacation a year.
Yeah.
Like, we've taken 2 weeks of vacation this month. Just this month. It's January.
Yeah.
Like, but they get 2 weeks a year. And I want my kids to think that there's this other world for them, right? And I'm like, why do you think it is that most people just want to work for 40 years and get 2 weeks of vacation a year? Like, imagine that life, right? And she's like, I don't know. I think, you know, because I guess going on your own is harder.
No.
Right? Kind of what you said. But I said, harder, but they work way longer than I do.
Yeah.
Right? So then maybe it's like the sense of risk. Maybe it's to the point that you said where, like, we've been told to go to school, get good grades, get good jobs.
Maybe it isn't.
Like that path.
It's not necessarily true that you work harder, although you probably do work a lot of, like me, like a lot of odd hours, and you know, you're always thinking about it. But I think it's it's risk. It's emotional risk. Like, it's risk about your self-perception. It's risk among your peers. Like, if all of your peers are...
So the fear, the risk.
Yeah, I think there's a lot of fear.
Yeah.
Or even, like, I don't know, like, entrepreneurship puts stress on my relationship with my wife, right? Like, we started this, but like, now it really starting to, it is like working, and it feels that way, but we're in year 3. Mm-hmm. Like, the first year we just like worked to get regulatory licenses. And then the second year we just like built tech, and then we launched. And then like now it's a year later and we're like, oh, it's working. But that's 3 years where my wife has had to be very patient and gracious, and that's hard. It's hard to make that choice when you have kids, when you have people who rely on you.
And it's certainly not a smooth path. I mean, my entrepreneurial journey has seen feast and famine, boom and bust, right? So then there's that as well. So safety or freedom or whatever, right? Safety or adventure. Right? I guess choose which one. So what other lessons, maybe if there's any lessons on management or like how you think about scale with a business? I mean, you had to have learned some really good stuff both at Stripe and Y Combinator. I'm just curious in that regard.
I think there's a tolerance for risk. We talked about a realization that the downside maybe isn't as bad as you can imagine it, that you can do things in the world. I think Y Combinator and Stripe are both very focused on having you be focused, maybe. So
like being really clear on what it is that you're trying to
or just
achieve.
like what matters. Like, people can really, you can fill your time with things that don't matter. And it's really easy, like in entrepreneurship sometimes, like to go to meetings or go to conferences or talk to people who aren't. So when I did YC, Paul Graham, who was the founder, was running it. And I think his line was something like, you should eat, sleep, exercise, talk to users, and code. And it's not on that list. Don't do it.
Right.
And so there's a certain discipline there of waking up and saying, like, what really matters. Not what makes me feel good. Not what's going to maybe get me esteem or make me feel like I have esteem. I find this actually a lot easier after having kids. Because every hour I am working is an hour I'm choosing not to be with them.
Put a new priority on.
Yeah, so it has helped me even like focus more. But I think that maniacal focus is something I definitely learned. On management, neither of those places, when I was, when you're in YC, you have like, it's you and your co-founder, or you and your two co-founders. And at Stripe, I think at the time there weren't managers. So it wasn't, I think in the overall journey of entrepreneurship, I'm in the process of raising some more money for Meanwhile, my company. And I had a VC, they wanted to interview a bunch of my team. So this happened just this week, actually, like interviewed like 4 or 5 people. And he was giving me a debrief just before I came over here. And he's like, these people like believe, like this is a mission for them. And it's so corny to like say this line where you're like, you don't teach people to build you don't tell people to build a boat. You like inspire them to long for the ocean, or like there are all these lines like this. But I think that's true.
Yeah.
And there's a lot of like tactical management things about like how you give empathetic feedback. But I think the most important thing I find is I need to believe in what I'm doing. And if you really believe in what you're doing, you need to find a way to communicate that to others so they believe. And then they'll run through mountains. Like then you're not telling people to work 60-hour weeks or 80-hour weeks or 100, whatever. They're working those weeks. Like you might have to tell them they need to do this better or that better. But that's, to me, like the core of management is to like think of it less about managing people and more about leading people.
Yeah. I love both of those tips are amazing, but the first one, which was like the maniacal focus, is something for the last like 6-7 months I've been just really honed in on. I had a conversation about that earlier today, and I think about the difference of Elon Musk, maybe the greatest tech entrepreneur that we have at least today, right? And a homeless guy, is how they spend their 24 hours.
Yeah.
That's right. Or difference of me or you. It's like, what am I choosing to read or eat or whatever? And it's like, and then when you start thinking about that, then it's like, what I say is like really being ruthless with how I spend every hour. And I love the point that you said about taking away from your kids. So I love that. Something, like I said, I think it's so, I'm super passionate about right now, and just like maniacal focus on that as well. Okay. So what I find interesting is you said that, working for Booker, you realized there was a problem with banking and people being unbanked and inefficiencies there. And then like going to Stripe as a company that sort of makes that easier. Yep. You set up another company that also helped with that as well. And like, I think as a founder, like we're trying to create solutions to problems.
Yep.
Right. So now you have a company that's in the life insurance space. It seemingly would be that you saw a problem that needed to be fixed and you wanted to solve that, but you said that you don't know it or didn't know anything about insurance.
Well, I didn't know a lot about insurance, I guess I should say, right? Like now I have to know like actuarial math and like tax rules, and I won't even bore you with the acronyms. Yeah. I mean, like there's so much about running a life insurance company, right? But I think that you're right that it's interesting, actually, in Bermuda, which is where our insurance company is based, they don't call it life insurance. They call it long-term insurance. And that is what really attracted us to it. Like, it's really about everything long-term. It's retirement. It's what happens after you die. It's what happens if you live longer than you're supposed to and you didn't plan for that. It's this class of, like, savings. And that's really what animated us from the very beginning, is we said, okay, there's this new economic system being built in front of our eyes, and it's an economy. It's not, it's not just trading numbers on a screen. Like, there's a new economy coming into the world, and it's unique in that it's global and it's decentralized and it doesn't have a government.
But, as far as Bitcoin.
Yeah, Bitcoin, yeah.
Right.
And that economy, more and more people are going to come onto it. More and more people are going to use it. It's going to grow. That economy is going to have like basic, fundamental financial institutions that are solving like core financial needs. And we came to life insurance like through that angle. We were like, okay, yeah, there are payments companies and there are banks and there are exchange or things that like look like banks and Bitcoin and exchanges. We're really comfortable with a lot of regulatory pain. That was something like we realized about ourselves. And we sort of naturally iterated to, this is like a core fundamental financial need. Like, in the end of the day, savings. And it really fits into hodling. Like this just like cultural idea in Bitcoin that you're saving for your kids, that you're passing on intergenerational wealth, that you're like hedging against inflation and currency debasement. And that like all fit together in our minds, like at the very beginning, like we're like, oh, this is like what life insurance is about.
Yeah. I love how you said that they don't call it life insurance, they call it long term.
Yeah.
And I think back to kind of the intro where I said like insurance is the most boring subject in the world, and most people don't want to put away for a rainy day of something that maybe never comes, sort of a thing. But I said that it's a tool though, and if you use the tool properly, you can build massive wealth with it. That's how I'm using it. Most people just don't understand that, so they're not interested in it. But sort of what you said, where
can I just add one thing, though?
Yeah,
I'm sorry to interrupt. Is that there's also this undercurrent that insurance, it can be like, life insurance in particular can be like needlessly complicated. And that complication partially exists because of the way life insurance is sold, right? So there are agents who sell life insurance. Agents want big commissions. So they're incentivized to sell you products that have high margins. High margin products tend to be like complicated products. So there's like all these terms and indices and optional options and riders and all this stuff. And I'm aligned entirely that like this is like a basic fundamental tool. Like, I assume we'll get to me describing the actual product we have, but it is like a product from the 1830s. It is like very simple. It's very straightforward. It's like fundamental. And I think it's not just that it's boring. It's also that the associations that people have with life insurance is like this thing that's being sold to you,
right?
Not a thing that I choose to buy because it's solving this like fundamental need I have in my family.
Well, and I think it's like, okay, great, so I pay every month, and then when I die, I get money.
Yeah.
But it's so much more than that if you use it properly. And I think that's what I'm alluding to, where it's not like just some boring thing where I just like pay every month, and maybe if I die within this time frame, I get some money, as opposed to like, oh no, there's a way I can actually build my wealth faster using it. So yeah, let's talk about the product. So how does the product help me to build wealth, store wealth, transfer wealth better than just the old pay for 20 years, and if you die within that time frame, you get some money?
Yeah. Well, I'm going to have to start by explaining some boring life insurance things. So our products...
They're important subjects, so everybody pay attention.
Our product's a whole life product, so it lasts your whole life. That's opposed to what you're talking about, which is term life, which lasts...
Insurance you buy versus insurance you rent.
Yeah. So a whole life lasts your whole life, and not to be the bearer of bad news for anyone who's watching or listening, since you will eventually die, there will eventually be a payout. Right. Now our product is called limited pay, so you don't pay forever. You pay for 10 years, although a bunch of people prepay. So you'll sort of like pay up front, and then there's a fixed guaranteed payout. So I'm just going to use like relatively large numbers. You might pay like 1 Bitcoin a year for 10 years. And then when you die, your kids, wife, beneficiaries will get 15 Bitcoin. So what are you getting from that? It is so much more than the 15, as you're saying. So the first thing is there is like literal protection, right? So you put in 1 Bitcoin the first year, you get hit by a bus, your kids get 15. So there is some like chance you'll die tomorrow, and you are protected from that in a, again, like inflation hedged, like durable store of value. Fundamentally, if you bought a whole life insurance policy in 2018, you've seen the value of that goes to your family decrease by 30% because of inflation?
Well, not nominally.
Nominally.
But in purchasing power.
In purchasing power, yes. So you've seen that purchasing power go down. Whereas if you had bought the same policy in Bitcoin, you've seen the purchasing power go up. So there's that protection and that like store of value.
for round, I mean, we're just spitballing round numbers here, but you're saying that potentially the amount of Bitcoin I put in could grow by about 50%.
Yes, that would be for like a 40-year-old healthy man.
A 40-year-old.
Yeah.
Right.
Versus
if I was doing a traditional fiat-based plan, I might see my wealth go up by 100% or 200%.
Yeah.
But the purchasing power of that
Correct.
100 or 200% increase in fiat went down versus even though my Bitcoin only went by 50%, not only did I get the 50% increase in Bitcoin, but I also got the increase
And actually, just to explain why that is there's sort of like a rate of return in the policy, right? So we churn 10 into 15, and we'll definitely talk about how we do that. But in a dollar policy, you go buy corporate bonds, there's like a treasury yield curve, like people can get 7, 8, 9% returns in dollars, and you compound that over your lifetime. In our policy, because it's in Bitcoin terms, that is everything we do is every promise we make, the whole company is entirely denominated in Bitcoin. We make a much more conservative promise on the yield because getting yield in Bitcoin is something we're very careful about.
Yeah.
There are no like safe 7% returns in Bitcoin. So that's why the ratio is lower.
Okay.
That actually gets to the second benefit. So the first is the protection. The second is we are turning 10 to 15. 2% returns inside the policy. If you could get 2% returns on your own Bitcoin, which maybe you can, maybe you can't, you would owe income tax every year. So that compounding, that growth inside the policy is tax-free. So in that way, it's like a 401k or an IRA or any number of like tax-advantaged vehicles. The third thing, which I think you've alluded to a few times, is that you can take a policy loan out of the policy. So you're putting this value in the policy. That value is increasing over time because of the savings rate. It is also increasing over time because the price of Bitcoin or the purchasing power ability of Bitcoin is going up over time. And then we comply with all of these complicated U.S. tax rules so that U.S. folks can borrow against Bitcoin out of the policy tax-free. So that means if Bitcoin is at $1 million a whole coin or 10 million, whatever you think it's going to be, and you need liquidity, you can pull value out of the policy without incurring new capital gains tax. So for most of our policyholders, we're really talking again about the hodling, like this is about saving for your kids. But also there's this optional, like be your own bank, like wealth building element of it. Mm-hmm. That if in 10 years or 15 years or 20 years, you did want to get some liquidity from your Bitcoin, this is the vehicle to do it in. Because if you sold Bitcoin like out of your self-custody wallet, you would owe capital gains tax.
Yeah. In whole life, most people sell it as like sort of like this infinite banking concept, right? Be your own bank kind of concept, right? Yeah. So instead of borrowing money from the bank at 8, 9, whatever the interest is, I can borrow from myself and pay myself. The key is paying myself back the same interest I would be paying the market.
Correct.
So you come out ahead. And so you're saying you could use it similar in a way.
Yes. That we have some policyholders who like don't even yet aren't married or don't have kids.
Yeah.
And I think it's both that they conceive of their Bitcoin wealth as like intergenerational savings.
Yeah. I'm curious on like a typical whole life policy, typically they have like a 5% guaranteed rate of return, for example, right? You're saying it's like 2%.
2%.
Is the 2% guaranteed? Like they
guaranteed?
Okay, so you have 2%. So typically like I would have a 5% guaranteed rate of return. And then I could borrow at maybe 5%.
Yeah. So ours works is that we guarantee you 2% returns, and then in the future you can borrow, and then our stated interest rate charges 3%, which actually like what companies do is they charge you what they expect they could earn on the asset you're borrowing. So you are like paying a little bit more than we're guaranteeing you, and how that works is we end up setting a maximum amount that you can borrow out of the policy, which is like 90% LTV against like the implicit value of the policy. And with that 90% LTV requirement, you can never owe more than the the death benefit that
Yeah.
you're owed.
And you're paying 2% compounding.
Correct.
And so what a lot of people don't understand is the difference of compounding versus simple interest.
Yeah.
So if I were to put $50,000 into an account and earn 5% compounding over 5 years, I think I did the math, it was like $67,000.
Yep.
If I borrowed the 5% back out and paid 5% interest, it's like it was like $54,000. It was a $9,000 difference, whatever the exact math was. But even though I'm earning 5% and then borrowing at 5%, I end up with a $9,000 advantage because one's earning compounding versus one is simple.
Correct.
So I haven't done the math on your numbers, but potentially, right, even a 2% compounding beats the 3% simple, or comes out somewhat. somewhat
because
close,
they come
right?
out basically
flat.
Yeah. That's sort of maybe the way to think of it.
Okay,
is, and then at the end of the day, you never pay you don't pay the loan back. You eventually die, and again, tragically, and then
We don't get out alive.
yeah, and then it's like netted against the benefit, right? So in the example I used earlier, where you've put one Bitcoin in a year for 10 years, you're getting 15 guaranteed when you die, or your kids are beneficiaries. And then, in year 15 or whatever, you want to borrow 5 Bitcoin out. You borrow that 5 Bitcoin out. It's it's a loan, so you're like being charged the interest. So let's say that 5 becomes 7. You die, then your kids just get 8, right? The 15 minus the 7.
Right.
The expectation isn't that people would like actively be trading the loan. And that's one of the things that people find attractive, right? Like sometimes we get asked this question, like, couldn't I just go on Aave or, some DeFi protocol, or couldn't I go to the bank and borrow dollars against the Bitcoin? But fundamentally, then you're dealing with a currency mismatch, and you're dealing with like the potential month over month volatility of Bitcoin, or having a margin call or whatever. In our case, you make the loan and like it's all in Bitcoin terms, so it's in that way a lot safer and more secure, and you're getting the tax benefit.
So when you say it's in Bitcoin terms, does that mean like when I come and make a loan or request a loan, it would be like, hey, I need 2 Bitcoin,
correct,
versus I need $200,000,
correct.
But then that would also mean I have to pay it back in Bitcoin.
Again, but because you have this death benefit coming in Bitcoin terms, it's not like you're not really short Bitcoin because you're
right.
You're long Bitcoin on the death benefit.
Yeah. Debt works really well in an inflationary economy. Debt doesn't work. Debt works against you in a deflationary economy. So that's just something to keep in mind. And then I think another strategy that people would typically employ on like a whole life policy would be like spending down the death benefit, which I think is basically what you're saying, right?
Exactly.
It's kind of the same thing, right? And then when you die, in this example as you proposed, right? So then my kids get the 8 Bitcoin, for example, or the 15, whatever. Is that tax free?
Yeah, it is income tax free. The way
not capital gains.
It's capital gains and income tax free.
Right.
Whether it's estate tax free is a structuring question. So
estate taxes.
Yes, estate taxes. So the way that works is,
do you have a trust?
You have a trust.
Is it irrevocable?
You have the irrevocable trust by the policy.
Right.
Which we have, users do that. So that the way you get an insurance policy outside of your estate is the same way you get like any asset outside of your estate. And we have policyholders with a range of sophistication and different structures. So that the estate tax is the only one that like you need like an extra layer of planning around,
and that's where you need to learn how to use the tool properly.
Correct.
It's a tool. But some people know how to use the tool.
And these things are actually somewhat in conflict that we've been talking about. Like, if what you care about is like spending down the policy before you die, you actually want to be the owner because you're the one who borrows against the policy. But if you're primarily using it as a tool to pass on Bitcoin to more Bitcoin to your children, then yes, you put it inside a trust.
It gets complex because my trust could borrow the money and then it could loan me the money.
Correct, and
so
then
we can do layers and
your wife's a beneficiary.
Yeah. So
Consult your attorneys.
Well, and it needs to be done on an individual basis.
Correct.
So this is something that does require, I advocate for using tax strategists and tax attorneys and then estate planners and attorneys and all those things. I mean, obviously depends on the size of your state. The more intricate you'd have to be.
But it's exactly what you said. Like, I guess just to pause and say, to go back to the financial inclusion story for a second, like, our ultimate vision, right, is if you're a middle-class person in Argentina, you do not buy life insurance because you are going to live longer than the Argentinian peso.
Most likely.
Right? Like, just historically, there have been many versions of the Argentinian peso over the last 50 years.
We might live longer than the U.S. dollar.
You might live longer than the U.S. dollar, right? So that's a core fundamental beginning for us is, most importantly, like, this is a tool in like the true global store of value, and like that is why we created the company. Now, it is also the case that every country in the world basically that has taxes has tax benefits and tax privileges for life insurance, for annuities, for various long-term insurance products. And that's what we've gotten into this conversation about. So if you're an American, we've designed the product specifically to comply with the tax rules so you can get those benefits. But it is like all these things at once.
Yeah. So you mentioned Argentina. So is it available in Argentina or is it only America?
Not yet available in Argentina, but that is an aspiration.
Yeah. So a couple things that I think about. So number one, like when I think about using these whole life insurance companies, I think about, will they be there in 50 years to pay that claim once I'm dead? Can they guarantee that 5% over a long period of time? Some of these companies have been around for 100 years or longer.
Hundreds of years,
Hundreds of years. But then I also still worry that, like, man, we had a decade of zero interest rate policies, and how far out on the risk curve do they have to go? And now with the COVID that we went through, like, they're probably way offsides on their actuaries, and like there could be a lot of potential risk there. So I think about that, as we should, right? Try to mitigate that risk. From a Bitcoin standpoint, it gets even more risky potentially, I would think. So number one, most people just right off the bat, they've been burned by the Celsius and the BlockFis and et cetera. And so, not your keys, not your coin. If I give it to you, I may not get it back, the counterparty risk that's involved, and then how much risk there is. So I'm curious how you think about mitigating those risks, right?
I'm glad you used the word mitigate because, like, in some ways that's all we can do is we can build these things. We can tell our story. People come to trust us. We're very fortunate that a lot of policyholders have come to trust us. But there's no perfect answer, right? Like, so you mentioned a lot of things. But let me start by saying, we are a regulated and licensed life insurance company in Bermuda, not the Bahamas. Bermuda is like a legit place where many life insurance and P&C insurance companies are domiciled. They're a quite difficult in a good way. They like provide a lot of oversight. They're really the only offshore jurisdiction that's respected both by the American regulatory bodies and the European regulatory bodies. There's all this equivalence and stuff. But what that means
So why would you go there as opposed to Bahamas since it's so much more difficult?
Because it's so much more difficult.
So you could have more trust and transparency.
Yeah. We could have set this company, like, it took us almost 2 years to launch. We had to write a giant business plan. We had to get an internal auditor, an external auditor, an approved actuary, a insurance manager. We had to like convince all these people none of who've ever thought about crypto and insurance before. We have a chief risk officer, a chief compliance officer, like 17 corporate policies, 850 corporate controls. We could have set this company up in Cayman or the Bahamas or British Virgin Islands a lot faster, but being in a jurisdiction that people know is trustworthy is super important. But critically, they're trustworthy, they're difficult, they're challenging, they provide a lot of oversight. And this is also where Coinbase's offshore operations are. They're also like very innovative. They want things to happen on the island. And in that way, we were able to have a dialogue.
I think they're the first country with the CBDC.
Yeah.
They are very Was it Bahamas, I think?
No, we're in Bermuda.
Bermuda, I mean.
I don't think they have a CBDC. They have
What is it called? The Shell CBDC?
There's a very interesting history on the monetary policies of Bermuda that I won't get into here. Anyway, do we want?
It was Bahamas.
Yeah.
Sorry, it was Bahamas.
I'm against it. So one is that there is a lot of oversight and like we're not like BlockFi, who is essentially like acting like a bank in this unregulated fashion. Like we started by saying like we need to be regulated and licensed. And what that ends up meaning in practice is that, as I said, like we're in the process right now of getting an external audit. Something that many people in crypto have never had, right? We have to post a bunch of capital, right? That's how insurance companies work. So we as a company have a bunch of our own Bitcoin in the company, and then users, pay us premiums, and then we invest that corpus. But our capital is like first loss capital, right? It's like we made some mistakes, the Bermuda Monetary Authority would shut us down, and we would have to like give everyone their money back, right? And we would be the ones who lost our Bitcoin first, right? So the way we gain trust is sort of like walking people through. You mentioned how it can be like a complicated thing to think about. Every single policyholder we have, every single person who comes to our website and signs up, me or my colleague Danny get on the phone and we talk to them. And we talk them through the enterprise risk management framework. And we talk them through, this is exactly why, to go back, we promised 2% returns. Because, is there a chance we could be wrong way on that? There is. But we definitely don't think there are 7% risk-adjusted returns to be made in Bitcoin. That's not where we want to be on the risk curve. So we deliberately made it a number that we thought we could achieve. And every single thing we do is in that conservative nature. Like the product is priced conservatively. To be honest, we reject a ton of people because every single person we take on, that's a liability, right? So we do underwriting, we make sure you're healthy, but that not only is about that person, it's about protecting the entire company.
Right.
We have a credit committee.
If you're offsides on that risk,
correct.
That's how insurance companies go down.
Yeah. And then on the asset management side, look, we have something that no one else has in Bitcoin, which is we have duration, right? Like users are trusting us with their Bitcoin for decades. And so we trade duration to counterparties, but what we want is credit protection. And we're really conservative. Like we're not YOLOing to Voyager or Three Arrows. Like respectable name brand institutional counterparties, we demand a lot of collateral or security, seniority, and we're like running a private credit desk in Bitcoin. And we walk people through that all. And I think we're fortunate that has given a lot of people an insurance. But the tax benefits are good too.
So let's talk about that a little bit, right? So if this is really fitting for a Bitcoiner, which is, as you kind of said, a long-term holder, right? Which it should be. I mean, if you're in Bitcoin, you should be thinking long-term.
Yep.
I try to tell people all the time, and it gets annoying, but I understand this is where we are in society today. But, where's Bitcoin going to be by the end of the month? Hey, it's January. It hasn't gone up. But you said it would go up in January, right? And I just tell people, like, man, if you're looking at your portfolio on a monthly basis, like you're just never going to make it.
I should say, this is the best thing about running a life insurance company is I get asked all the time, like, what do I think is going to happen with the price of Bitcoin? And I say, I have no idea. I don't know what's going to do today, tomorrow, this week, this month, even this year. The conviction I have to have, and I try to get our policyholders to have is, I believe Bitcoin will have more purchasing power in 20 years, in 30 years, in 40 years.
Yeah.
And that's the timeline that we're thinking on.
But I also feel like figuring out where it will be in 10, 20, 30 years is easier than where it will be in 10, 20 days or weeks.
100%.
But what I was going to say, though, is so if you think about it long term,
yep,
then a strategy like this can work because I'm thinking long term. And so ultimately my goal to get it from 10 to 15 over, decades makes sense for me.
Correct.
And so some of the ways I can do that, number one, compounding at 2%, great. But also like tax efficiencies.
Correct.
Right? So, if people are trading their Bitcoin, they could potentially be losing up to 50%. Short-term, gains or whatever. So think about every time you try and buy and sell around the cycles, you're losing 50% at a time.
Yeah.
As opposed to just like, so I guess maybe some of the tax efficient strategies, what would be a couple things that you would tell someone who is long-term focused, a couple of the things that they may want to think about as far as like really increasing their stack? Using this type of a tool in a couple of maybe ways that most people wouldn't think of that really helps them increase their stack.
Well, there's a question of like this tool and in general, and I just want to start by saying I completely agree with you in that I think very few people have the ability to, or the luck to like time the markets carefully. There's a lot of like transactional costs to like selling and buying Bitcoin. I'm like relatively proud of just like setting it and forgetting it on Coinbase. I'm not necessarily advocating for Coinbase, but like I just dollar cost average into Bitcoin over 7 or 8 years. And I think that was like a great decision for me. I think like that's a great way to think about it. But yes, this policy in some ways, like I'm designed a whole company to solve my own problem, right? Like,
okay,
I have 2 kids.
That's the way it typically starts.
Yeah. Like I have 2 kids. I believe that Bitcoin will be significantly more valuable in purchasing power terms in the long future. That's not year to year, but certainly decade to decade. And life insurance is, for me, both instills discipline in that like it's in this policy, and it has like the tax benefits that we mentioned. The other thing actually is like, there's a whole other angle. Like we have a legal obligation to make sure your beneficiaries get the payouts, like to the best of our ability. And there are like tragic stories about people who like mismanage their keys or, they die and then their like wife has no idea how to get their Bitcoin or doesn't know where it's buried. So, that's also, there's just like practical operational legacy benefits to insurance, to the life insurance product. But I want to like connect your 2 questions and say, like, we're very honest about what we do, right? Like, and there's a lot of things that are uncomfortable. Like, you send us Bitcoin, and there's a real reason for that, by the way, because a lot of what tax and estate planning is about is like getting whatever your asset is like just slightly outside your reach, because that is what makes it like not part of
force the discipline.
Yeah, no, but it's not just forcing. I mean, like legally, like that's what makes it like not taxable.
Oh, right.
Is that it's not something that you can like actively manage. So we take possession of your Bitcoin. We have possession of everyone else's Bitcoin. So there's like a hypothecation. And then we do like super conservative lending with the Bitcoin. Mostly like way over collateralized. Actually, there's some interesting things we're doing there. But that's uncomfortable. All 3 of those things are uncomfortable. And what we find in every like Bitcoiner's heart is this tension between a love and desire for self-custody on the one hand, and a like love of good tax optimization on the other. And people are just on that spectrum. Mm-hmm. And the thing that we are very clear about is like, maybe this isn't necessarily for all of your Bitcoin.
Well, that's a great point. I was
right. Like people, you have some self custody. Maybe you have.
You don't put all your money into insurance.
You don't put all your money in it. Like
you own other things.
Yeah, and maybe you have some at like Casa or Unchained and some multi-sig solution, and maybe you have some in the ETF. I don't know. Yeah, and maybe you have like some in this product. And like another thing that people love is we have a max. Like, so our smallest policy size is 1 Bitcoin, so that's a tenth of a Bitcoin paid over 10 years. And our biggest policy that we'll accept is up to a death benefit of 50. But particularly for like really big whales who have been like burned, 5 BlockFi and other things, when we say like we can only take like 25 of your Bitcoin, you want to give us more, we can't take it. And I think that like the point is like the reason we do that, by the way, is if if you take too much risk on one person's life and then you just get unlucky, that person gets hit by a bus.
Yeah.
Then you're screwed, right? And like,
Sure.
right? So we're like, every choice we make is a choice to be long-term. What jurisdiction we're in, like limiting our policy size, like who's our independent board members, like all the way down. Because I fundamentally believe, just to be selfish for a moment, like this is going to be a huge company. Like it is such a fundamental financial service, like in this rapidly growing economy.
Yeah.
And the only way I'm going to screw it up, just to be selfish, the only way I'm not going to make like billions of dollars is if we screw up who we insure or we screw up asset management. So like we work really hard to make sure those things are right.
Yeah. I want to wrap this up, but I want to ask you one other question. So, we're thinking long-term here. We're thinking death benefits to our beneficiaries. We're gone. This is something that I spent a lot of time thinking about, legacy. You're a father. There's a big growing movement, and especially really seems to be strong in the Bitcoin community, but also globally, right? There's a best-selling book, Die With Zero. Really, the fiat system is designed to like save up, live off my savings, and hopefully die at zero, right? The book's Die With Zero. And a lot of people, especially in the Bitcoin community, I see them saying, "Oh, leaving money for your kids is terrible." Jimmy Song went back and forth with me on that. Like, you can't leave money for your kids; you'll ruin your kids. Blah blah blah. I disagree.
Yep.
What's your take? How do you think through legacy planning?
Yeah.
Passing down to your kids, kids. Is that good, bad? How do you think about that?
Yeah, it's interesting. There's this tension between like Die With Zero and like retire my bloodline. Those are like the two like estate planning or memes inside the Bitcoin community. Look, I understand. I haven't talked to Jimmy about it, but like I sort of understand this idea to go all the way back to like entrepreneurship, to agency. Like, how do you inculcate in your children a desire to be more than what you give them and to strive to like make their lives better, to make their kids' lives better, to make the world better. And I sort of think that that's something that's so important and worth working on, but that doesn't mean that you should deprive them of everything you've worked for either. I think having a legacy for your children and maybe your children's children, although your children's children you'll know. Your children's children's children is a little more abstract. I think it's worth planning for, and it's worth thinking about, and it's worth designing a little bit of your life to think about that. I have to believe that. I guess I started a life insurance company, right?
But how are you thinking about it for your kids?
No, I mean...
They're young right now. It may change as they grow older.
I was the first policyholder of Meanwhile, so I don't want to... I think it's a hard question. Sometimes, I had a relatively tough upbringing, and I noticed that a lot of the entrepreneurs I know, they have some like childhood trauma or life trauma, and that like motivates them. And you want your children to not be traumatized, but then you also want them to like work hard.
Yeah.
And I think that tension exists outside the question of whether you should leave them some wealth. I think you should, because like, what are you, or that's part of what I feel like I'm working for, is for my children. And then additionally, I'm also like, think a lot about like how you inculcate those virtues in your children to not necessarily decide what I would decide, but how to, be wise.
So the way I think about it is that money doesn't make kids bad.
Yeah. Okay.
So if you
Better way to put it.
if you raise good kids, hopefully they'll be good kids. If you raise bad kids, so money seems to exaggerate or magnify, right? So I loved what you said, right? Which is like, not just helping the kids, but the world. So I just think about like we earn wealth, we create wealth by solving problems, which is providing value to the world. I think about money being important to help my family have options and help more people in the world. So if I think that we should use money to solve problems in the world, I want my kids to think about having money and solving problems in the world. So if my kids want to be actively solving problems in the world, they should have access to the money.
Yep.
If they want to have access to partying and drugs and doing nothing, then they probably shouldn't have access to the money, right? I shouldn't enable that, right? So then, how good have I raised my kids? They say the sign of a good father is not how good their kids turn out, but how good their grandkids turn out. So I think about that, and then what we've done inside of our trust is set up a family constitution. So then the family constitution is a guideline of what my values are, the way I view the world, the way that I think we should be bringing value to the world. We should take care of our health. We should take care of others, all these types of things. And then there's like restrictions. So then it's like the trust then is managed to a constitution, just like a U.S. Constitution would have. And then the trustee will determine if the heirs, and it could be kids, are living up to the terms of that Constitution. And if they're not exuding the values and virtues of that Constitution, then they don't get access to the money. And then in making sure that the money is there to help them do more, but not hurt them. So, for example, if they are able to qualify to buy a house, certainly we'll give them the money to buy that, like as a down payment on the house, certainly, right? But if they're just doing nothing, they don't get the money. Yeah. If they want to launch a business that they have a sound business idea and plan for, they can have the money to start a business, right? And so there's guardrails put onto it, things like that. These are things like the Rockefellers did so well, right?
That was immediately what I was thinking about. Is like the multi-generational trusts, like Rockefellers or the Pritzkers.
So those worked really well, but then it comes with like, what type of education am I putting into the family? And the Rockefellers have taken it way more serious, where each generation then has to go through right education and all those things. But anyway, I was just curious your take on it, and I guess to the point that you said your money's where your mouth is, so to speak. Yeah. Obviously, you believe in generational wealth because you started a life insurance company. Yeah. Man, we covered a lot of ground. It's gone long. That's great. I love it. Yeah. Like I said, I spent a lot of time at this stage in my life. As I've gotten older, my kids are getting older, I think about it a lot. I think just from a long-term hodler perspective, Bill Gates said, who I don't really like to quote, but Bill Gates said that people overestimate what they can do in a year, but underestimate what they can do in 10. And I think that really applies to building wealth, right? Because like, kind of going back to the story I said earlier about people working 40 years and getting 2 weeks of vacation a year, they hope to have $1 million or $2 million when they retire. And so like to increase your stack by 50%, which could be millions and millions and millions, like don't underestimate that. Like the tax efficiencies you could gain could be more than what most people would hope to make over that time period. So good stuff. We're going to link to your stuff down in the show notes down below if anybody wants to get in touch with you guys. Yeah, meanwhile, we'll link to that down below if they want to get in touch with you. And anything else you want to close it out with?
No, thanks for having me, Mark. And I'm so glad you're familiar with like the virtues of life insurance, and that we were able to talk through it. We take it very seriously, the obligation that we're making to every single one of our policyholders, and there's nothing more important to us. And I'm really glad to have got to talk it through with you.
Cool. Thanks. All right.